Cost, volume, profit. The first page of the notes is a legend of all of the abbreviations that I'll be using throughout the notes. So take this page and look through it, pause here, get a chance to look through it, and then when we go back to recording the lecture or listening to the lecture, you'll know what these symbols mean. We will start with the contribution format to learn about cost, volume, profit analysis. This is an exercise from your homework, and what I'm doing is showing you how I set up each one of the problems each time. If you set it up the same way, you will always be able to solve no matter what the question is asking you for. So cost, volume, profit looks at sales minus variable cost to yield the contribution margin, from which we subtract the fixed costs in order to determine the profit. We will use this formula in a variety of ways to gather information about the company. Now, at the various points in time, you may want to refer to the other videos where we go through the calculations on cost, volume, profit. But in the interim, I'm just going through my notes to kind of orient you to my way of thinking about these various topics that we're going through in each of these chapters. So here are the abbreviations. I use the financial symbol, the pi symbol, for profit. So in this instance, we have total dollars minus our variable costs, which yields the contribution margin, from which we'll subtract our fixed costs, and that will yield our profit. It's the same information as you would use on a financial statement, but we're preparing it on a different basis for internal financial decision making by internal users. So we have the same information, but we're putting it in a different way. We're looking at the way the costs behave. So we're segregating variable costs and we're subtracting those from sales, and then we're segregating fixed costs and putting them all together and then subtracting them from the contribution margin. We also look at it on a per unit basis, and we also look at it on a basis of the ratios, variable cost to sales and the contribution margin to sales. And I don't remember what volume we're looking at, so whatever 208,000 divided by 26 is, that's the number of volume of units that they're selling. So contribution margin analysis is used to obtain sales quantities to break even. So a company wants to know, how many units do I have to sell in order to break even? Because if you can break even, a company can stay in business for the next month. So it's kind of like a zero-sum game, kind of like the bottom line. What do I need to know to break even? And also, you may want to look at it as sales quantities, but you may also want to look at it as sales dollars. What sales dollars do I need to achieve to break even as a business? This is very good information for a business, especially a small startup company. What do I need to do to cover my fixed costs and gain a profit? And also, we're going to be looking at sales quantities to reach a target profit. So once we get beyond the break-even stage and the company is more well established, then they're going to look at certain target profits. So we'll use that same formulation of the contribution margin, sales minus the variable expenses, in order to talk about a target profit as well as target profit sales dollars. So let's look at break-even analysis. The contribution margin, which remember here, which is sales minus the variable cost, is equal to the contribution margin. The contribution margin lets you know what dollars are available after variable costs have been deducted from sales. To break even, a company must have enough sales to cover its fixed expenses. Variable costs, by their very definition, are a percentage of sales. So every time you sell something, you are invariably going to incur these variable costs. So immediately upon a sale, a portion of your sales is not going to be available because it's going to be absorbed by variable costs. So what's left over is the contribution margin. And so in this instance, look over here at these ratios to the right. We're assuming that 40% of all sales is those costs are already incurred, and 60% of all sales is left to cover your fixed costs. Well, your fixed costs are things like rent, things that are fixed in nature, and they're usually associated with expanding capacity. So when you get a larger building, when you incur fixed costs and you have them and you have to meet them, you have to know how many sales do I need to incur in order to be able to cover your fixed costs and be able to stay in business one more month. So there's some formulas, because this is a very dynamic relationship. There's some formulas we're going to be looking at. So to obtain break-even sales, and I'm going to abbreviate it as BE superscript S, the formula is fixed costs minus the contribution margin ratio. So remember I said we want to set it up the same way each time, in total, by the ratios on a per unit basis. So now when we're looking for sales, we will always be looking at the ratios. So a lot of the formulas that we have are going to be the same. We'll be looking for sales, and we will always be looking at ratios in those instances. So the mnemonic to help you remember the formula is sales ratios. So this will be the fixed cost divided by the contribution margin ratio. So our fixed costs were $150. Our contribution margin ratio was $60. So let's look at that. Let's look at $150 divided by 60%, which equals $250. So let's prove that we've got that correct. $250 minus the variable costs are 40% of the $250 means there's a contribution margin of $150 from which we're going to deduct our fixed costs, and we can see that we can break even. Now, in my notes, in your homework, and sometimes on tests, there are going to be various ways to calculate the contribution margin. So here I'm giving you some additional formulas that you can look at in order to be able to calculate the contribution margin ratio. So when you print out your notes or you pause this video, just take a look at that. But I'm not going to go over it because I don't want to spend 3 hours on a lecture. We only want to listen to the most salient points listening to this YouTube lecture. All right, so now let's talk about break-even quantities. So we looked at break-even sales. Now let's talk about break-even quantities. This is break-even with the superscript Q, right? Well, just like there was sales and ratios, the way to remember this is quantities always means that you're going to be looking at contribution margin on a per unit basis. So you're going to be looking at per unit. So we compare this to break-even sales where we're looking at sales and ratios. All right, so let's look at it on a per unit basis. Our sales price per unit is $25. Our variable cost per unit is $10. Our contribution margin per unit is $15. So let's take our fixed costs of $150 and divide it by our contribution margin per unit. So this means that we have to sell 10 units to break even. Well, $25 is what we sell them for. We need to sell 10 of them, so 25 times 10 is going to be $250. Variable costs are $10 per unit times the quantity that we're selling to break even, 10, $100, $150 in contribution margin, fixed expenses $150, so we break even. However, if you have total sales and total variable costs as well as the number of units sold, you can determine these on a per unit basis, okay? So if you already know the number of sales that you need to have and the variable costs that you need to have, and you can look at your units sold, you can also determine the sales price per unit and the variable cost per unit. So that was just another little caveat on how to calculate sales, variable costs per unit and sales per unit. Okay. All right, so this is an exercise from your homework. Normally, this is included in my notes because normally in a face-to-face class, we would be working this example in class. So let's go to the next page in notes. You can also use the contribution format to determine sales and quantities to achieve a certain profit. Okay, so now your company's established. You're always going to break even, but now you want to target a certain profit. Say you as an owner, remember owners or sole proprietors can't give themselves a salary, but they can withdraw money from the company and record it under withdrawals, and it's a corporation under dividends. So now you want to be able to take a certain amount out. So now you're going to start toying around with, what do I need to sell in order to achieve a certain profit so I can get a certain amount of money back? So in this example, we're looking at the target profit the owner wants to get back is $300. So the formula will be the target profit sales. So T with the profit, that's my abbreviation for target profit. And we're talking about sales, right? When we talk about sales, again here, we're going to talk about ratios. So you're going to be looking at the contribution margin ratio. Well, when we look at the target profit, we're going to treat it just like a fixed cost. So we're going to add target profit to the fixed cost, and we're going to divide that by the contribution margin ratio in order to figure out exactly what we need in order to sell, in order to get $300, okay? So we have, let's prove it here, and these are just different notes on how to solve the problems when you run across it in homework, okay? So we said our target profit is $300 plus $150 in fixed costs, so that's $450. Our contribution margin ratio was 60%, so $450 divided by 60% is $750. So let's multiply. We know that 750 of them is what we have to sell, so 750. Now, in order to calculate the variable percentage of these sales, we would look at it in one of two ways. We can either take the 750 that we're selling and divide it by $25 per unit sold. Remember, we're selling these for $25 in order to determine how many we are going to sell. So we need to sell 30 of them. And we know that our variable costs were $10 per unit. So we're going to multiply 30 times 10 in order to come up with 300. That's one way to solve it. And also, by doing that, you've solved for your quantities too as well. Or we know that the contribution margin was 60%. See 60% here? Automatically, therefore, the variable percentage had to be 40%. Right? Because their complements both will add up to 100% of the sales price, right? So variable cost would be 40%. So we could take 40% of 750, and that would give us $300. So we see with $300 in variable costs, sales of 750, gives us a contribution margin of $450. From that, we're going to subtract our fixed costs of $150. So that will give us our target profit, just what we were trying to achieve, of $300. Now, a caveat to this is that it assumes the sales prices and variable costs are constant. And also, it assumes that costs can accurately divide it into pure variable and pure fixed costs in order to be able to derive this. So when you're trying to determine what goes into variable costs, what should be accumulated there, and what should be accumulated in fixed costs in order to make these numbers pure, you're going to have to plan from the beginning in your company that you can isolate what's variable and what's fixed. And so this was target profit quantities. So remember, like with the quantities for break even, we are going to look at quantities on a per unit basis, right? And on a per unit basis, our contribution margin on a per unit basis was $15. So our target profit plus our fixed costs, $450, divided by $15 per unit for the contribution margin, equals 30 units that must be sold. So again, a problem I would normally be working in class. So let's use what we've learned so far to begin making some business decisions. So we have a little company called Who Dat Headphones. And so we have our sales price per unit of $250, our variable cost per unit of $150, and our contribution margin, right, when we subtract our variable from our sales price, we're going to have a contribution margin per unit of $100. And so when we looked at our ratios, the variable costs are 60% and our contribution margin is 40%. And our fixed costs that we have are $35,000. So a lot of your homework problems will be set up just this way. So what are the break-even sales and break-even quantities? If the sales are $375, what is the profit? What are the break-even quantities and break-even sales if fixed expenses increase by $10,000? And what are the break-even quantities and break-even sales if variable expenses change to $200 per unit? Okay, so let's take a moment and take a screenshot or print out these pages so that you'll be able to look at what the questions are when I go through the answers. Okay, so one of the questions was, what is our break-even sales and our break-even quantities? So our break-even sales, our fixed costs were $35,000. Our contribution margin percentage was 40%, so that means that our break-even sales have to be $87,500. We want to look at our break-even quantities as 35,000 divided by $100, which is the contribution margin per unit, and that will be 350 units. So let's prove that. We said our selling price is $250 and our variable costs per unit are $150. So here's our break-even quantities. We'll multiply it by the sales and variable costs. That means $87,500, which was our break-even sales. We're going to subtract out the variable costs. That means that our contribution margin is $35,000, and so our fixed costs are $35,000, so we're going to break even. Next, we said if the sales quantities are 375, right? What will be the profit? Well, we could do it the long way, 375 times the 250 and times the 150, or you can kind of do it the short way, which is sales quantities of 375 minus our break-even quantities of 350. That will equal to 25 more that you're selling times the contribution margin per unit times 100. So the short answer is your profits will increase by $2,500 if you sell 25 more units. Next, we had a scenario which said, what if break-even quantities and break-even sales if fixed expenses increase by $10,000? So one way to look at that is to simply look at, and this is just more of the answer too. What if fixed expenses increase by $1,000? So we can solve it one of two ways. We can take break-even quantities is equal to 35,000 plus 10,000 times the contribution margin per unit, and that will mean that we have to sell 450 units. Or we can do the sales, which would be $45,000 times the contribution margin ratio, or $112,500. Or you could simply take 10,000, right, like I did here, and you can divide it by the 40%, and that will immediately give you the new break-even quantities or the new amount of profit that you would receive. So we can see here that if you take the new fixed expenses, then, I'm sorry, I said that wrong. You can take the new fixed expenses and you can divide it by the contribution margin percentage. So if you know fixed expenses are going up by 10,000, you can divide it by 40% and immediately know that you need to make an additional 25,000 in order to break even now, because your fixed expenses went up by 10,000. And we can prove that by taking the original break-even quantity, adding the 25,000, and you get to 112,500. So I'm showing you some various ways to solve these problems. You can always do it the long way, but if you want to do it the short way, there's shortcuts that you can use. And once you start playing around with these formulas, you'll see that they're very powerful and can be used in a variety of ways. So what if variable expenses changed to $200 per unit? Correct? Because originally they were $150 per unit. Well, that changes a lot of the dynamics. So now a way to solve that for break-even quantities is, let's look at the original fixed cost of $35,000. And so now our sales price was $250 and our new variable costs per unit are now $200, which means that our contribution margin per unit now is $50 as opposed to $100, which it was originally. So now we can see we have to sell double the amount. We have to sell $700 in order to break even. Our break-even sales Again, $35,000 in fixed costs divided by the contribution margin per unit divided by the sales per unit in order to come up with a new contribution margin ratio. Or you could just do it like this over here to come up with a contribution margin ratio. A variety of ways that you can calculate that, and you can see now that your break-even sales are $175,000. So when your variable expenses go up, it's going to have a much larger effect on your company than if your fixed expenses go up. So note, $700 times the sales price per unit means $175,000, which means the new break-even sales are $175,000. So these formulas can be used in a variety of ways to calculate and analyze the effects of the changes in cost, volume, and profit. So now let's look at a new topic. Cost volume profit analysis is also used to calculate the sales volume or sales needed to attain the margin of safety. So now this is for a much more well-established company, and so now you're in the budgeting realm and they're thinking to themselves, what kind of margin of safety do I want when I budget my sales? They're always looking for a cushion to make certain that they're not getting into any financial trouble. So what is the margin of safety? The margin of safety is the excess of budgeted or actual sales over the break point. It's just a percentage. It is the amount by which sales can drop before losses are incurred. The higher the margin of safety, the lower the risk of not breaking even and incurring a loss. So safety margin sales are SMS. The budgeted or actual sales minus the break-even sales. Well, it's pretty easy to figure out the budgeted or actual sales. What you have to do is just be able to calculate break-even sales. And so how do we calculate break-even sales? Sales ratio, so it's going to be fixed costs divided by the the contribution margin ratio, okay? So in this instance, let's use an example. Our sales are 100,000. Our break-even sales are 87,500. Our safety margin of sales is 12,500, or as a percentage is 12.5%. So you have to be able to calculate break-even sales to calculate the safety margin of sales or even the safety margin ratio. There's a good discussion in your book on cost, volume, profit considerations in choosing a cost structure. So you want to look at that in order to be a complete accountant, but it's going to be more than I'm going to go through on a lecture here today. And FYI, this is a very good book to keep for your accounting libraries, and one of the reasons why I selected it for this class. So again, here's an example I would have used in class in a face-to-face lecture. So here's some notes. I just want you to read through that on structuring sales commissions and how that can have a huge effect on a company. Again, I'm including this in your notes for completeness so that you'll be a complete accountant and aware of all of these topics. And also, too, I'm including some information here about sales mix and how that can affect a company and that they want to have the proper sales mix. Now, a complete discussion of this is beyond the scope of this text in looking at it in a very detailed way, but I want you guys to be aware of these topics as you go through. And then there's some information on a multi-product break-even analysis. It's not going to be in your homework or on your test, but again, I just want you to be aware of these topics. And so here is just a reiteration of all of the formulas that we use. So we're concentrating on break-even sales, break-even quantities, target profit sales, target profit quantities, as well as safety margin of sales and safety margin of safety margin ratios. I'm sorry, I'm trying to remember everything I was thinking of. All right, now here is a reiteration, a complete listing of all of the formulas that we use so you can kind of look at this when you're studying for your test and be able to recapture that. And again, these are some of the examples that I would use in homework in class in order to be able to walk you through how to calculate this. And so let me pause here and just remind you that a lot of the calculations and looking at the formulas are going to be also in the calculations videos that are also on this YouTube channel. So go through those as you go through everything that you need in order to understand this, but I also kind of want to take some time and record some video lectures on just walking you through my notes. Hope this is a benefit to you. Email me with any questions. Let me know if you're having any problems, questions, or concerns. And as always, I'm here to help you.